Okay, thank you very much, Adinda. Everybody at FX Street, very glad to be here today. Today is September 27th. We're going to have an education class. This is a co-production between FXDD and FXStreet.com. We've been doing these for a number of months now, and it's always exciting. Now, if you hear some energy behind me, I'm on the trading floor live in New York. I'll be patching in with Greg. Okay, so our disclaimer is that we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, so this is Greg Michalowski. Many of you know him from his speaking engagements around the world. I'm Sean Powell, national trainer at FXDD. Between the two of us, we've been in the Forex markets for over 30 years combined. Greg is the man of the hour, and he's someone that teaches all over the world and is very well respected. He's got his new book out now called Attacking the Currency Trends. Definitely pick that up on John Wiley & Sons. Let's talk for a moment now as well before we get started about fast track trading. This is a new program. I don't know if you've heard about this. FXDD is going to be launching these across the country. Our first one takes place in Phoenix, Arizona, and it's going to be on the 15th of October. Now, this is a new format that we haven't done before. I don't know if anyone has done this yet. We're doing two webinars on Wednesday the 12th and Thursday the 13th, and then the live event, which takes place in Phoenix, Arizona. You have an opportunity here to register for this. The landing page is fxdd.com/fasttrack, and we'll type that into the chat window once we get the ball rolling. So hit that page, watch the video, and you'll find out all about it. Low cost to attend, and I think you guys will have a great time with it. So with that being said, I'm going to switch the role over to Greg, and we're going to get started for our training.
Okay, thank you very much, Sean. My name is Greg Michalowski. Thank you very much, Sean, for that introduction. Thank you, the people at FX Street, for allowing FXDD to help you in your trading here today with our educational course. And today I thought I would talk about using multiple time periods for your trade picture, for a better trade picture, for a clearer trade picture. It's often wise, I think, as a trader to not have too many things going on at one time in your price graphs. I get a lot of retail traders who will have lots of different indicators, lots of different tools that they'll use on a chart. And by doing that, it's a natural reaction, especially for newer traders, to do that. Why? Because knowledge is power, we're told. And we're also told that the more we know, the better we're going to do. That's the case in a lot of businesses and a lot of things that we do in life. And so we're kind of programmed as humans, aren't we, to do this in our trading. So we have lots of different indicators. We learn a lot. And that's good to a point. And then it becomes more, you have a negative, excuse me, on the margin, each additional tool that you add actually starts to be more detrimental to your trading. You have more conflicts between some of the tools that you use, and this causes some anxiety. Maybe it increases your fear, and that's never good for a trader. Now, where I think more actually is good is when you look at different time periods of a chart. And before I get into talking about that and looking at that more specifically in charts, I want to ask you all a question. Do you characterize yourself as more of a day trader, an intermediate or maybe swing type trader, or a long-term trader? And you can answer that yourself. Most people do characterize themselves as one or the other and those people who are day traders, well, typically will not have positions overnight, and that's fine. I have no problem with that. Intermediate term traders or swing type traders will look for those bigger term swings in the markets and look for those trades that maybe they'll stay in for a day or 2 or 4 days, depending upon if the trade is working in their favor, if the market is trending in their favor. And then you have longer term traders. And I always go back to go back to Gartman, Dennis Gartman. He's a money manager and well respected. You'll probably see him on CNBC and some of the other business channels from time to time, more often than not. And he characterized one time his position in gold, and he said that they asked him, what made you get into it? And he says, well, initially it was a trade, and then it became an investment. So what he was saying in no uncertain terms was that he put a trade on with a shorter term perspective, maybe with a tighter stop, with an idea that this may do this, that, or the other. And unfortunately, in this day and age, it doesn't necessarily pan out the way that you think it does. And so I think what he was saying at the beginning of the trade was that he had the idea, and he was right in his idea, that the market price action proved him correct, and the market did what he thought it would do. Then it becomes more of a managing trade, managing a position as opposed to a shorter term trade. So those are the three types of traders that are out there, and you are probably one of those types of traders. But where I think retail traders tend to think when they characterize themselves either as a day trader, as an intermediate trader, or long-term trader, is that they will concentrate on charts that are consistent with their trading focus. For example, shorter-term traders might focus on a 5-minute chart or a 15-minute chart or perhaps a 30-minute chart. And that would be their focus of their trades, and they'll just concentrate on that one time period of a chart. Intermediate term traders might look at the 1-hour chart or the 4-hour chart. Maybe some of them will venture a little bit into maybe a daily chart from time to time. Most of the time, they're going to focus on this types of time period charts. And then you'll have the longer term traders who will look more at the daily chart. Maybe they'll look at the weekly chart or even a monthly chart and see what those charts are telling them. And is that type of focus always good? And my answer to that question is no, okay? It may be good at certain times, but it's not necessarily good all the time. And in fact, you can make yourself a better trader by opening up a little bit more, by taking an extra step. And it's not intended to confuse you. It's just intended to give you more confidence and also give you more trading clues that you can rely on in your trading that will allow you to actually be better at what you do, to be able to see things that you normally would not see by just focusing on your one chart. And I like to say that it can save traders from doing trades they normally would do if they're, let's say, focused strictly on a 5-minute chart or 15-minute chart, by focusing on other time periods. Even though you're not trading for an intermediate or long-term time period, focusing on other time periods may actually stop you from doing trades that you normally do. That is actually good for your trading. It will prevent you from getting bad trade location. It also can give traders multiple reasons to do a trade. I already mentioned that, which increases confidence. And if there's anything that traders need, especially retail traders need, is confidence. Because confidence, what does it do? It decreases your fear. It allows you to trade more with an open mind. Any trader that trades with fear is typically trading is not going to do well. Anything that we do in life where we have fear, we're typically not going to perform at our peak. So look at athletes. If they have fear of a certain pitcher or something, let's say a baseball player or a certain team or whatever, they're typically not going to do well. If they are able to diffuse that fear, take that fear away somehow, look at a pitcher without being intimidated, they're going to swing more easily at the ball and hit the ball further. If a football team is intimidated by another team, if they take a attitude that that they're just as good, or they're not scared of that player across from them, they typically will do well as well. If they have fear, that player is going to eat them up usually. So you as a trader, have to find ways to make sure that your fear is decreased, and by looking at multiple charts, it's often a good thing. Knowing what other types of traders are looking at is a good thing. Being focused just solely on what your specific chart is good, but it's better if you know what the other guys are thinking about. If you know that the guys who are focused on the daily charts, the weekly charts, have a key level. Those are key clues that are going to make you a better trader and allow you to perform more at your peak in your trading. So, with that said, I thought I would, with that introduction, I thought I would take a look at some charts, take a look at the multiple time periods, and show you exactly what I do when I analyze the market, when I look for trading opportunities in the market. So let me take my screen off here for a brief moment, and then I'll bring up my charts and bring back the screen. All right, now you can see it. All right, so we got the dollar Swiss. It's a 5-minute chart here. I'm glad you all can see that. And this goes back a little bit to the beginning of September, beginning of this month. And this is a 5-minute chart. And someone who's looking at this, I want to show you, some clues that may lead to trades by not only just looking at, let's say, the 5-minute chart, but looking at the other charts. And so, if you're a trader, you may not even be focused on this 5-minute chart. You may be focused on something else, your daily chart or your weekly chart. So, what I'm saying is that if you're a daily trader, hey, maybe it's okay for you to take a look at the 5-minute chart, see what that is saying, see if there's any clues in the market, see if you can apply tools that you use on maybe your daily analysis on your 5-minute chart another time period. Try to put odds of success in your favor. Maybe it'll stop you from doing a trade. Maybe it'll get you in a trade. Maybe it'll do what the Gartman said and get him in a gold position that from a technical perspective with good trade location will allow him to benefit from a move either to the upside or the downside. So here we have a 5-minute chart, and we're looking at this formation here. And needless to say, we have this triangle formation forming here, where we have lower highs along the way, and we have higher lows. And I've put in a couple trend lines here. I know we broke above this level right here. This was a spike that quickly rejected itself and started to come down. And then we kind of had a little bit more of a consistency here. We made another high here, made another high at this point right here. And then on the downside, we had some higher lows here, and we moved down a little bit more, and we made another low here. But the other thing that I have in here is a couple moving averages, 100 and the 200 bar moving average specifically. And I like to use these two moving averages. They're simple moving averages. They provide you clues as far as the market. And one of the clues that they do give you is when they converge with the price. I call that three is a crowd because there's three things there, 100, 200 bar moving average, and the price all converging to the same area. And when you see that, that's saying to me the market is non-trending. So that's a clue to look for, either a break to the upside or a break to the downside. And the final move right before the market started, a little move to the upside, or move to the upside here, was an attempt to move to that upside at this point right here. That move above here actually failed, and the market started to come back down. We actually took out these lows right here, and then we got another failure. So we had, if I were analyzing this chart on a 5-minute basis, I would be saying, being a little bit confused here. Why? Because we failed on the break to the upside here, but we went up to our trend line here and held that level. So that's a bearish break here. that should say that the market should go down, and then that's what the market did. And the market went down, and we took out these lows right here. 1, 2, 3 lows right here. The market took it out, and it could not sustain any move to the downside either. There's no momentum to the downside, so what did it do? The market then started to move back to the upside. These are 100 and 200 bar simple moving average. Blue line is 100, the green line is a 200 simple moving average. So when the two of them converge and the price converges, that's what I call three's a crowd. Because that old saying, two's company, three's a crowd. When you have that situation in a social environment, the third person is supposed to go off away and get away because you're being in a crowd. You want. And so I equated it to trading here to make it easier for people to understand. Two's company, three's a crowd. What moves away? The price moves away. So we have a failure above, failure below, and the market starts to break to the upside. You have to go with this. This is giving you a clue on the 5-minute chart that something is. I'll get to current charts later. I'll get to them. All right. Start to move to the upside here, and then if you go to the hourly chart and take a look at the hourly chart. It's showing, what is it showing here? It's showing a move to the downside here, and this is the same day, and we retrace 38.2% retracement of that move to the downside, and then we start to form this flag formation here, and the market breaks up above, moves higher above that flag formation, and then moves above the 38.2% retracement. All right, and so this is giving you a clue that the market has, is turning more bullish. So on the 5-minute chart, we broke above the trend line, and on the trend line in this area right here where the market was forming, and on the hourly chart, what's it showing? It's showing a break above the 38.2% retracement. Could you have seen this on the 5-minute chart? Well, if you went back far enough, but sometimes you have to look back in time and take a look at what the technicals are saying on a longer term view. And the hourly chart certainly gets you into that view. So that was giving you some bullish signs here in the market. In addition to that, note here this 100 bar moving average. In this case, we're looking at the hourly chart here, and this is the 100-hour moving average. The market moves above that, comes up to that level, finds resistance, retraces, and where does it find support against? The 38.2% retracement. I'm going to zoom in here just to show you these little clues that the market is giving you. Clues that maybe you don't see on your 5-minute chart if you're focused on that. Clues that maybe you don't see on your daily chart if you're focused on that. And this is what we're looking for in clues from looking at all different charts. So I will look at this and see the market come up to the 100-bar moving average, see the market retraces 38.2% retracement. Know that the market broke above this trend line on the 5-minute and the hourly chart, and know that the ability to see these levels and understand these levels are clues that tell you have to be long the dollar versus Swiss. It just is telling you from a technical perspective that that's what you have to do. And so when the market then bounces back above the 100-bar moving average, we end up getting this sharp move to the upside. And what do we know from that? That's the intervention. That's the intervention that happened because on that day where the dollar Swiss and euro Swiss, the euro Swiss moved up 10 big figures, and the dollar Swiss also moved up sharply to the upside here. So what am I trying to get at? Well, what I'm trying to get at is if you're focused on your different on different charts, you can see things in a clearer way. You, as a trader, end up having what I call trader's luck because you get this event that happens that forces the market up in a dramatic fashion to the upside. But it was all predicated on the fact that you were focused on what intermediate traders were doing, what medium to shorter term traders were doing, and perhaps even longer term traders we're looking at the same time. In this case, the move actually off the daily chart really didn't give you that many clues here. But what it did show is if you take a look at the daily chart here, it was also giving you a little bit more of a bullish bias. Why? Because if you look at the daily chart and take the low going back to August and move it up to the high that occurred here, What did we break below? The 38.2% retracement. What did the market not find on the break of the 38.2% retracement? Additional sellers. We couldn't get to the 50% retracement. The next day, before the day that started the move to the upside, we held the 38.2% retracement. And on this day, the real clue in the market on this day, and these are levels that I look for. I'll put up this chart and I'll see where my key levels are. I know that the 77.89 level is support, and I know that this trend line above here, this trend line which really goes back quite a long way, connecting a number of different highs along the way. We broke above it. We failed above it on this move at the end of the August period, and the market moved down. But so this really didn't kick in until the 80.16 level once the intervention had occurred. But the clues really were focused here at the 38.2% retracement. So, Boyke, why do I show this chart? I'm an educator. I'm trying to show you instances where you look at different types of charts along the way to get your clues, to get your ideas about what may be happening from each perspective. And this is going to increase your confidence, increase your knowledge about what the market may or may not do, allowing to put the odds of success more in your favor. Good. All right. Cool. All right. So now let's move on. Take a look at some other charts. Take a look at what the clues the market's going to give you, and see if we can analyze different aspects of certain charts to see what they are telling us. What they are telling us from a perspective of the different types of traders that may be looking at those. So let's take a look at the euro versus a U.S. dollar. You want to look at today's analysis? Take a look at it. From the euro's perspective, we'll start off with the daily chart here. And what do we know about the daily chart? And what can this daily chart tell us about the current market? Tell us about the bias, perhaps, of the market. And what I have here on the daily chart, go back in time, and we look back at the most recent longer-term low here. I think everyone would agree that the most recent longer-term low came in here in June of 2010. The market moved sharply to the upside, or moved to the upside, trended to the upside, had a good correction here, but you know it was a trend correction, larger term correction here, which really put into question the overall trend of the market. It probably went below the 50% retracement and such, but then we had a nice little trend into the 2011 high. Using a Fibonacci retracement, which is another tool that I like to use, you put the Fibonacci from the low to the high, and then look at the certain Fibonacci levels that are important for your trading level. And what do we know about recent activity here? 134.07 level was a key level. Okay, if I were to look at this chart here, and look at it from a few days ago, or even from an analysis standpoint, what I will look at and what I'll say is that this 134.07 level is in play. This is a level that is of significance. Level is a 50% retracement of the move up from the 2010 low to high. If you're a shorter term trader, that may not have any interest to you, or it may not be something that you would be aware of. But if you're, what I'm saying is that, hey, you should look at it. You should understand that the 134.07 level is a key level. If you're going to be trading intraday, that may be a level that you're going to find some support, or perhaps even find some movements through that level that may allow you to have an opportunity to sell the market. In addition, off of this chart, you can go back in time. You can see this low that occurred back in the month of February. That low came in at the 134.27. So the 27.07 level on the daily chart is in play. Okay, that's levels that I'm going to be concerned about, maybe focus on, understand that they exist. Okay, that a longer-term trader may look at that level, and especially in light of the fact that the market's moving sharply to the downside, moved 10 big figures to the downside in the span of the three or so weeks of trading, that may be a level where the market finds some support. And it might be enough to change your perception on the market. So from that chart, you start to work into your hourly chart, and this is again what I look at for my intermediate term perspective. And in this case, I will put those lines in 134.07, 134.27 level in there. And what can we see from the action that occurred around these levels? Well, we see that the market moved below the 07 level for the first time at this point right here and quickly rebounded at this point. If you're a shorter term trader, you know that 07 level is an important level from the perspective of a longer term trader. The failure of this move below this 07 level and the ability to find that support is a trading opportunity at this point right here. It's a trading opportunity at this point right here when the market goes in between the 07 and 27 level and starts to come down. It's a trading opportunity on the break to the downside when it starts to move through here and moves to the downside. And it also tells you to get out when the market moves back to the upside at this point right here. So it becomes a level where you can define your risk. And you as a trader need to define your risk. Why do you need to define your risk? Because that's what all businesses do. All businesses look to define their risk, to make sure that they understand their risk, to make sure that they don't blow up their trading account as a result of some fundamental reason that says the euro should be going to 128, like what people on TV may have been saying at that point. 134.07 was a key technical level from the daily chart. It also became a level that intermediate and shorter term traders can focus on as well. And so what we see here is that the market, it does move up and down. It is consolidating, but there are trades from a shorter term perspective that you can take advantage of that allow you to benefit from the fact that you were looking at that daily chart and found the support. Again, here we find support, and here we find support at the 27 level before the market moves sharply to the upside. Now let's go to the 5-minute chart, and we'll even move closer into our trade here today. But again, the purpose of this show is for knowledge of education. So here you look at the 5-minute chart. And we spread it out a little bit more and take a look at those moves below the 134.07, 134.27 level. And you can see the action here in almost even a clearer view. You can get to see how the market breaks below the 07 level here and quickly rebounds to the upside. And you get actually another chance right here. This may not have been seen in the hourly chart to actually purchase the euro against that level. When you get this volatile markets here, being patient, waiting for those opportunities to present themselves. Here's our 27 level. We see how the market found support against the 27 level and moved to the upside. All these short-term trading opportunities for you as a trader. Pay attention to them. Know where they are. They will get you better trade location. On the failure right here, we have this little bar that sticks out like a sore thumb. It breaks to the 27 level. Can't get to the 07 level. Boom, right to the upside here. This is where energy is developed, folks, because it started on a daily chart. You don't need to be a shorter-term trader, or knowing that, understanding that is important. When the next time the market comes down to 07, we start to move through that level, break through, and what do we find support here? 07 level, boom, to the upside here. These are the things, these are the clues that you want to look at. All right, so the question comes in: which time frame do you trade on? Enter, exit. Boyke, it depends. My entry on these trades were predicated off of the daily chart, right? They're predicated off the 134.07 and 134.27 level. This is one of the themes here. Those are that is a level that came off a daily chart that allowed me to define risk in a shorter term environment. So if I was just focused on the 5-minute chart and not being more open to looking at other charts like the hourly or in this case the daily chart, I may have missed that trade. I may have been thinking more to the downside at this point right here, new move to the downside here, instead of thinking of taking profit or looking for an opportunity of a corrective move to the upside. So the point is that you as a trader or what I try to do is I try to focus on all of them and say, hey, this is a key level for this market. Think in terms of, let's say, let's go to the euro versus U.S. dollar chart again. And the market's moving sharply to the downside right here. And what do we approach? We approach this key 100-day moving average right here. Now, you can imagine that the 5-minute chart and the hourly chart is showing bearishness. The market is moving to the downside. We took out the old low right here, but the market finds support against or moves down to the 100-day moving average. The first time it's been to the 100-day moving average since this point right here. And that becomes the focus of my trade. So my entry, even though I may be a shorter term trader, is actually on the daily chart. All right, that is the step that allows that gives you an advantage in your shorter term trade location. An hourly chart is going to show negative. A 5-minute chart is going to be showing negative. But this daily chart is showing this is a good level of support. This is a level where the market should pause. This is a level where if you are short, maybe a level that you take your profit against. So I'm trying to make it so that you as a trader and looking at multiple time periods, just one shorter term, one intermediate term, one longer term chart, and some people may use a 15-minute, some people may use a 4 hour, some people, typically will use a daily as a longer term chart. But by looking at these different charts and different time periods, shorter term, intermediate, and longer term, it can make the picture more clear. It can prevent you from selling the market at this point right here when you should be buying and taking profit at that level. A 5-minute chart is not going to show you to buy at this level. A daily chart is going to show you to buy at this level. So open up your mind to multiple time periods, multiple time frames. Don't overdo it. You don't need to look at every single time period. One short term, one medium term, one longer term chart is going to give you the clues that you're going to be able to see, give you the clues that allow you to see this 50% retracement at the 134.07 level, and make a judgment on your 5-minute, on your hourly chart that the 07 level is a key level, and you can see it more clearly, and maybe catch these trades, these short-term trades, these trends that are going to make the difference in your account on a shorter-term basis. All right. All right, I can go on to the sterling versus U.S. dollar, and just as and I'm going to take this just a quick look at this, but what I want to point out here before we get into looking more at the more recent markets here, the market here today, is once again on the daily chart. Look back in time. If you're just focused on your daily, on your 5-minute chart and your hourly chart, what are you going to see? What are you going to miss here? You're going to miss these lows here, this lows right here. Number of different lows that occurred here at the 153.42 level. The market moved down below that level and moved back up above that level, leading to an opportunity to actually get in a good trade location, take your profit. Here's that 42 level on an hourly chart. You can see the resistance at this level. Market is trending. The trend stops at that key level. Why does it stop at that key level? If you're looking at the hourly chart, you're not exactly seeing it clearly. When you look at the if you look at the daily chart, you can see things more clearly. And at this point right here, where we start to see a double bottom here at the 26 level, a number of different times the market tried to break that 42 level. A number of different times the market rebounded back to the upside, back to the upside, back to the upside. One final move, failure, and eventually that market is going to start to move to the upside. So when you start to see the break here, it's giving you more clues as far as directions that you see. On the 5-minute chart, you can do the same routine. Go down toward that 42 level, and you can see things how breaks the 42 level, moves above, starts to move higher. Look at this move back down right to the 42 level. Break through, support 42, move to the upside. Support, move to the upside. Fail here, move to the upside. Break through, find support, move to the upside. You can see the action around that 42 level. That 42 level is a specific level to this market, and it's clear, or it shows here on the 5-minute chart how the market moves away from it. It may trade around it. It may go above it. It may go below it. But what you typically see is a move, a rejection, and then it becomes what becomes a bearish move turns into a bullish move right here. When we come down, we find support, moves higher. When it breaks through, it should go lower. When it moves back above, it starts to use it as support, so on and so forth. And you can see how it leads into what we see here in the market and the corrective move to the upside. All right, so let's take a look at the current markets and try to make some heads or tails out of it by taking a look at the different, some of the different currency pairs. So does anyone have a currency pair that they want to take a look at, and I'll try to put my spin on it, or not my spin on it, my analysis on it from a daily, hourly, and 5-minute chart perspective. All right, dollar Canada. I have some horizontal lines here going in here in the dollar versus Canada. These horizontal lines, because the market was in a non-trending period area here. What I'll do, and the market hasn't been at that area, for quite some time. This goes back to November of last year, so we're really in new territory here on the break to the upside. So I'll put some horizontal lines in across the way on the daily chart. And again, from this perspective here, I mean, I had these highs right here are levels that you want to pay attention to. The levels that define risk, that allow you to get risk. So off the bat, the market, if I zoom in here, the market went right up to that old high. And I can go back in time, just move your cursor all the way back in time to the last high that occurred on 12/20 here at the 102.08 level. And the market comes right up to the 102.08 level, starts to move down. We break above the 102.08 level. What should the market do? It should, 103.65 level. Again, I'll zoom out here and go back in time to these points right here where the market had highs here, the one at these highs. And so if you zoom back in, the market went to that level, moved above it, and then starts to move to the downside. So from this daily perspective, we also had these other highs here, these horizontal lines here. I'll be paying attention to these levels as levels that are in play. All right, that means that if the market stays below the 102.72 level, that is going to be bearish for the chart. The market should have a bias in that direction. It simply becomes, a point where it's bullish above, bearish below. That's why I put these lines in these charts. So let's go to the hourly chart. 102.72 was that old high. So I have the 102.72 level here in the chart, and from this perspective here, from the hourly chart, what are you going to say? The market held the 102.72 level, had a little bit of a tick to move above that level, which, by the way, took out this high. This is what you're looking for. Okay, you go to the daily chart. You move back in time to the 102, to the last time, these levels that are significant from the past, and you go back to this congestion area where the market, actually the 100 and 200 bar moving average converged at this point. This is one of those threes, a crowd thing, and the market trended to the downside. So this area is going to be, this level is going to be a key level for traders to define, to lean against. And so, what do we see here? The market moves here. And what else do we see here? Well, on the hourly chart, we have these lows coming into play here. 1, 2, 3 lows right here. And what do we have here? The 100-hour moving average. So if you're a trader and you see this the 72 level formation show here, then that's this level hold here, what are you going to be looking for to break on the downside as far as the target goes? The 100-bar moving average and these lows right here. These are another key level for the currency pair. And what do? We break down, we come back, we test that 100-bar moving average, the market moves lower. So from my perspective now, looking at the dollar versus Canada here from a daily perspective and also from an hourly perspective, I know we also have a 38.2% retracement. That's of this move. I should probably move this lower to that most recent low. Is that we broke through the floor here. We broke through the 100-bar moving average. What is your resistance? Where can you define your risk at the 102.29 level? If you're short this currency pair, the next target to get through is the 38.2% retracement of this move to the upside here. But what is the bias here? How would you define your risk? Well, 102.72 and the 100-bar moving average starting to move give you reason to think that the market may correct, and that's what the market has done. Since the last move is a bullish move to the upside, clearly the trend, this trend is to the upside. Market moves sharply to the upside from the 97 to the 103, 600 pips to the upside of the last couple of weeks. This 38.2% retracement is probably going to be a level where the market finds buyers. Why? Because that's a longer term trend. But from a shorter term perspective, from a day trading perspective, we got our clues from the daily chart. We solidified those clues from looking at the hourly chart and seeing the action. We've solidified the bias to the downside by looking at the 100-bar moving average, and we know that we have a key level to get through right here at the 38.2% retracement. You could take profit against this level and sell on a break of the 38.2, looking for a move down to the 50%, down to the 200-bar moving average. That's your call. The clues, however, for the downside today were made up here and at this point right here, and allowed you to take advantage of it. Let's just take a look at the 5-minute chart, see if we can make any sense of this, and see if there are any additional clues that the 5-minute chart allowed us here in today's trading. And from the here, let's put our horizontal line at the 102.72 level. Let's also go to the hourly chart and get this level where the 100-bar moving average and the trend line came in at 102.21, 22. Right there. And off the 5-minute chart, what is clear here? What makes the picture clear here? Well, here's our 72 level at this point right here. Here's a 100 and 200-bar moving average coming together at this point right here. When the market breaks the 100-bar moving average, we come up, test the 100-bar moving average, and start its move to the downside. Our next target to get through is a 21 level. That's the 100-hour moving average, and the market breaks below that level and comes up, and where do we test? 21 level, and starts its move to the downside. So from an intraday type perspective, from an hourly perspective, from a daily perspective, all the markets kind of line up, don't they? They give you extra clues, they give you ideas as far as, and they prove themselves. Okay, they prove to be important. Someone who's looking at the 5-minute chart may not understand the importance of the 72 level, and may actually think that the market is going to move to the upside. And that's okay as long as he understands that if it doesn't do what it should do, that is move in this direction here, get out of that trade. I'm not saying, there are times where you are going to lose in trades. Why? Because your bias is more of a corrective move to the upside rather than a move to the downside. So you're thinking this break is going to go that way. But what you should also understand is that you are not necessarily going to know exactly whether the market's going to do what you think it should do. That is move further to the upside. So that's why we trade at these key levels. That's why we look at multiple charts to determine that, hey, 72 level is going to be a key level. It's going to move above that level, and I'm going to see this market head back up to this level at 103.17. If I'm wrong, this is my stop, back below the 200-bar moving average or back below the 100-bar moving average. That's my stop, and I'm out of that trade. I was wrong. That's the essence of trading and defining your risk, understanding what your risk is, and going from there. Should I pay attention to dollar index movements when trading currency pairs? I don't, because it's not going to define. It's not if you're trading a currency pair. Well, here, no. Let me take a step back. You can use it as a secondary tool, okay? But it will not define your risk as a primary tool. And what I mean by that, Soul Man, is that if a technical level on the dollar index is broken, that may give you a bias to the to the upside or the downside for the dollar. Okay, but as you know, the dollar index consists of a basket of currencies, and so if you're trading the euro off of that dollar index, that basket or the composition of that basket is going to remain the same, but there may be currency pairs within that basket that cause the market to, or cause the dollar index to move one way or the other. And that composition or that movement in the dollar index may be influenced by the dollar Swiss. For instance, if you get intervention by the Swiss National Bank, guess what? The dollar Swiss may be the most influential currency within that dollar index, and you're trading the euro. So what I say is that, hey, you could use it as a secondary tool to give you a bias as far as which way the dollar should be is going. Maybe it broke through a 100-day moving average on the dollar index or something like that. So that gives you an indication for the direction of your trade. It may give you a bias as far as which way the market may be going, but always determine your risk. You always determine your risk on this chart. You always determine your risk from this level right here, or this level right here, or on the 5-minute chart, the break of the moving averages and the failure of the move above the 102.72 level. That is where you define your risk, because the dollar index is not going to tell you where to get out of your dollar Canada trade. It's going to the only chart that's going to tell you where you are wrong in your dollar Canada trade is if it moves above this 102.21 level. That's when you know you're wrong. Or if it fails to get to the 38.2% retracement and find support at the 101.56 level, comes down to that level, and the low for today came in at the 101.65, so got within 9 pips of the 38.2% retracement. Maybe that's where you take some profit. So that's where you're going to find your interest, or where you're going to do your trades. So use the dollar index as a secondary tool. I'll get to another currency here in just a second. How do you use volatility on 5-minute, 1 hour? Do you use moving average line to deal with intraday volatility risk? I'm not looking for I'm looking for levels that patient levels that make sense to me, and looking for, if I'm trading intraday, looking for those clues along the way that are going to allow me to get to have a meaty intraday trade. All right, and then what I do is I look for, if I'm trading intraday, let's say on the 5-minute chart, I know that this is a good trade entry at the 134.07 level. We've gone through that a number of different times. What now I have to do is now look for targets along the way that the market has to get through and move and continue to move in the direction. So and that gets into managing the trade. So for instance, once I'm in at the 134.07, and I can do a whole course on exits and all that other stuff, and so you're going to have volatility, you're going to have little spikes, moves along the way. But if you have great trade location or good trade location because you do your homework and you understand that this level is a key level in the market, and you happen to get great trade location, and that's what I'm trying to get you to have that good. You're in charge. You're in charge, and that ability to be in charge can give you the confidence to live through the volatility. Okay, to be able to say that 134.07 and it moves up and down here and comes up to this line right here and moves back down, you're still in charge, and now you start to manage your risk. So you're long at 134.07. You're not going to lose on this trade. You need to get up to get to this level right here. It gets to that level, and then you fall. It's going to correct, and you have some volatility. But can you move your stop down to the 38.2% retracement? Yes. What happens out here at the 200 bar moving average? Does it break below that level? Can't get to the 38.2, so moves back below the 200, moves higher, and that's That's what you're trying to catch, is these moves to the upside. Now remember, by defining these levels and by keeping your risk to a minimum, by understanding where they're at, you're able to risk a little and potentially make a lot. So you get good trade location, whether it's up here against the 100, 200 bar moving average when it moves. By the way, on the euro versus U.S. dollar, we broke above the 100 bar moving average here. We came up to this trend line, move to the upside here. It came back down to the 50% retracement of this move to the downside right here, and moved a few pips below that level and below the trend line, but it gathered the pace and moved sharply to the upside. This move to the upside, this little corrective move to the downside here, that can be as expected, but we found that support against 78 level. We went to a low here at 71, 72, and the market took off from that level to the upside here. Broke through this. This is a key level in the euro now, by the way. In your trading here this afternoon, 136.23 to 30 level is going to be your key level. And if you take a look at the 5-minute chart here, we have this. What do we see here? We see the market moving down below the 30 level, okay, and coming down to our support level here, moving back up to that 30, got to 36, 37 at this point right here, but then started to move back to the downside. Would some people get stopped out up here? Yeah, it went. Maybe you shorted the market on the break of this line right here, and you got stopped out up here. Yeah, but when it started to come back down here, we're seeing more of a inclination to move to the downside again. So the 30 level is going to be a key level there today. Okay, I'm getting asked gold. I have a few more minutes here in gold. What do we see here? Well, we have a trend line here on the daily chart. 1, 2, 3 different points along that trend line. We have, when I'm analyzing the chart, what do we have here? We have one high, we have two highs right here. Is this trend line going to be important in our trading? Yeah, it's going to be important. Is it reluctant to go, to move, and to trend through when it broke through that trend line? Yes, it was. It was reluctant to go through. Why? Because it's hard to break the habit of this bull market, all right? It's hard to break that habit of the bull market, especially when you're still getting negative news out there. Any negative news, used to lead to just higher prices in gold. So what do we see here? We see the market consolidating at this level above the 38.2%, around that trend line. But then we get a clue at this area right here that that extends through the 38.2% retracement at this point right here. You get the sellers against the underside of this trend line, which again has 1, 2, 3 different points, broke through it here, and you get the clue here. And so your mind should start thinking, and when you get the move through the 38.2% retracement line, your mind should start to think, all right, things may be changing here. And it does. And so the market comes down. We come down to the 100 bar moving average and find a little bit of support breakdown. And where do we go? Yesterday we go right down to the 200 support. Boom, right back up to the upside here. So where do we stand now in gold on the daily chart? We're above the 100-day moving average. That level comes in at 1640.09. Let's go to the hourly chart. 1640 is a 38.2% retracement of this last move to the downside. So it's right here at this level. This is the 100-day moving average here in gold. Off of the hourly chart here, I have a Fibonacci going to the downside here, corrected 50% of this move to the downside. Maybe this is a trend to the downside. Maybe put it right here, whatever. Right to the 50% retracement, and the market starts to move to the downside. So we get this sharp move to the upside here today that runs right into the 50% of this last sharp move to the downside. So what do and by the way, that this old trend line here, which broke through here and started to move to the downside. Really, took off. By the way, this is from this low to this low. This trend line. Let me see where this comes from. There we go. That's this trend line right here. This trend line right here, low here, low here, low here, continues down this way right here. When we break through it, look what happens. Market comes right to the underside of that trend line, boom, to the downside. We come up to, we can test that trend line 38.2. Little correction move to the upside, 50% retracement, starts to move down. So we're right in between now, support and resistance here in gold. I would use 1674. I'd use 1640 as your key level. We have the break of that trend line, and we should head to the downside. Do you set your fibs on daily charts, not on hourly or 5-minute charts? No, I set fibs on all charts. Again, I want to know on the daily chart. This level becomes important. The 1647.04 level it is an important level. 1640 is also a level. So it's less so because on the daily chart, actually, what are we doing? We're correcting this move to the downside. So really, your Fibonacci should be like that. And that's and by the way, off the hourly chart, this is of the last move to the downside. Off the daily chart, this is the longer-term trend, and where do we go? 38.2% retracement, 1680, and the hourly chart comes in at 1674. So there's resistance, so there's, you can, this is again, and I didn't even know it existed, but this is where you have the confluence, where you have the hourly chart and the daily chart coming together, get together to say that there's something up there between 1674 and 1680. And of course, when you get a $70 move or something that we had in gold, $5 or something is not a lot, So it's kind of horseshoes and hand grenades when you start to deal with some of these more volatile currencies like gold. And by the way, is gold a currency? And then maybe some of you are upset that I'm talking about gold, but gold also helps to move, help move the euro up, and maybe that's helping to move the euro down here on the as it moves back to the downside. So I would use Fibonacci's, and I'll use different Fibonacci's on the charts, and I find that they work well. And again, it's the focus of what the shorter term trade or the intermediate term trader might be looking at versus the daily trader. And if you can get them to convert have similar levels, it becomes more of an important level for the market at that area. So, another lesson in what we're doing here. Off the 5-minute chart, let's see how the 5-minute chart's looking at, or how it's looking. Here's our 5-minute chart, 100 and 200 bar moving average converge. Market comes down, tests the 100. Market comes down, tests the 100. Tests the 100. Market comes down. It starts to lose its momentum here. When it breaks through the 100 bar moving average, starts to consolidate more. And the market comes down to test the 200 bar moving average, and on the 5-minute chart, and shows some support at that level. If I were to just draw my little lines across here at old highs and lows from an intraday perspective, you can see some reason to think that this area right here is a support level, right? And from this perspective right here, what I would say is that this is what I call in between the goalposts. It's below the 100 bar moving average, above the 200 bar moving average. The market is in between two goalposts, and so what you'll find is that the market, the 100 bar moving average here should now be resistance at the 1662 level, and if we break through this 200 bar moving average, break through the 48, break through the 45 level, and start to make our way. That would get us through this. It's not going to get us to the 100-day moving average, which is at 1640 level. But all these levels now become the next key levels on the downside. So put a horizontal line at 1640. Go from there. Market likes to use tools, folks. Market likes to use technical tools that people can follow, that people can see, that people can understand. So it's 12 o'clock now, New York time. Sorry I didn't get to, I hope I was able to answer more of your questions. Let me just put the sterling Swiss up real quick, and then we'll finish up here. Not getting any Sterling Swiss trying to find some support against the 100-hour moving average here. Nice came down to that level here today and bounced off. Lots of up and down volatility here in that currency pair, as you can see. Off of the daily chart, broke above the 100-day moving average, found some resistance against the 200-day moving average. That is going to be, that's a level that you have to pay attention to. That's the level the market's going to pay attention to at that point right there. And if you see the rotation back to the downside, that's what you're going to be looking for. Off the 5-minute chart, let's see if this makes any sense. Data's coming in. I'm not doing that. That's the data coming in. Yeah. Those who trade the Sterling Swiss know about the volatility here in this market here on an intraday basis. What I can say is 100 and 200 bar moving average are coming together here. Why? Because, well, look at it. It's pretty obvious here. The market should start to use these levels, to move away, bullish above, bearish below, and see which way it goes. When the market moved below here, fell sharply, came back to the level, fell sharply again. It gets a little hard to explain at this point right here as the market just starts to consolidate, but looks looking a little bit more bullish from a 5-minute perspective here. Paul Volcker, ex-Fed chairman, is saying the euro and the euro-yen moved nicely today from the 100 to the 200s. That's right. So anyway, these in volatile markets, you do have to look at all these different moving averages, and a lot of times in markets, moving averages, trend lines, Fibonacci retracement levels. Those are the 3 tools that I use, and a lot of times the market will want to use those levels in order to define risk. So I am done. I thank the people at FX Street for once again providing me with over an hour of talking to you all. I thank you for your questions. I thank you for your patience. Remember, when I come in here, I'm not necessarily here to give you, this is what you should do in the market now, everyone go out and do it. I would rather teach you how to fish. I only talk to you twice a month. I'm going to teach you how to fish so you can go out and do it for yourself, not for me to tell you what to do today, what's going to happen in the euro or this pound sterling. So my goal here today is to teach you guys how to fish, and you women how to fish out there. Hopefully you'll catch a few of them along the way, and you'll be able to take that to the bank. All right, everyone, have a great night. Thank you again for your support. Thank you again for your questions. Thank you again for your challenges, and we'll see you next time. And thank you, FX Street. Bye bye now.